Well, good afternoon, everyone. Welcome to our annual meeting. I think on behalf of my team in New York, I want to welcome all of our friends, all-time shareholders, to this annual meeting. Now, this year, we're going to do in the, the agenda is obviously we're going to go through performance of the year, some of the recent investment themes, and what we think is going to drive performance for the fund over the next 12 months or so. But we have something else exciting to talk about, which is our 30-year anniversary. Doug mentioned already, we had a really nice celebration at the Royal College of Surgeons earlier in March. And I spent quite a bit of time here going about the future, the formation of the fund, history, some of the really big milestones over the past 30 years. We discussed as well, what we did right, what we did wrong, lessons learned. But most importantly, in March, we were highlighting 10 big mega trends. The 10 trends which we would think, if we would be standing here 30 years from now, what would we highlight as the major milestones for the past 30 years? And I think that's a really interesting refresher, and I'm going to address that at the very, very end of this presentation. But let me a little bit talk about the formation of the fund, And this fund was actually, the idea for this fund was born by a group called Finsbury Asset Management. Their leader there, William Salomon, together with Anthony Townsend and Max King, they came 30 years ago. They had this idea, let's build a global pharmaceutical fund. Because back then, there was no ability for UK investors to invest abroad. So they had only GlaxoSmithKline, AstraZeneca back then as opportunities. But William Salomon, he really strongly believed that there is a major opportunity by investing inside healthcare on a global basis. And he knew Orban Med Advisors in New York. We had a co-investment in an Austrian plasma fractionation company. So he knew us well. And we created this fund back in April 1995. Now, the first money raise was terribly difficult. We raised just 60 million pounds. And there was one investor, Paul Gaunt, who joined actually the board of directors. Without him, this fund would have never gotten off the ground. But it was a really opportune money raise because we had right away after we launched the fund a mini biotechnology bull market. And we always invest a lot in biotechnology as well. So we're really good off the starting block. And then we raised another $38 million here one year from the start. And I think this first raise, if you look at the money raise, 50 million pounds, basically created the current size of the fund. You have a 40x here in the fund over the past 30 years. So all of the additional shares issued was offset by shares bought back. So the initial shares would have created the current fund size just by performance. Really interesting tidbit as well in the early stages. The first 4.5 years were actually terrible. We underperformed the benchmarks. We had no chance with our heavy allocation to biotech, underweight on pharmaceutical companies. We were underperforming the big pharma companies because back then, all the big pharma companies, they were merging with each other. GlaxoSmithKline, SmithKline Beecham, and so forth. And they were outperforming everything else in the stock market. But then look here in year 2000. This was when the human genome was sequenced. We had a major run in the innovative biopharmaceutical companies. We had a huge run in performance then, big outperformance. I think this is 2000 is still our best relative outperformance here. Now, another important milestone was when we raised another $100 million in 2004. And then in 2010, very, very important change. This is when we slightly adjusted our investment mandate. Before, It was a pure biopharmaceutical trust, but we saw a lot of opportunities emerging as well in the medtech space, in the services space, in diagnostics and tools. And this is when we changed the mandate, we changed the name as well. So instead of Finsbury Worldwide Pharmaceutical Trust, we became the Worldwide Healthcare Trust. So really important milestone. In 2015, we did our first new logo. In 2016, we reached another very important milestone. First time, £1 billion assets in the fund. So really, this is when we became institutionally sized fund. Now we peaked actually in total size at $2.5 billion. This was in 2021. The reason why, even so, we reached a new all-time high in 2024, why we are not bigger than is share buybacks. So we shrunk the fund actively with share buybacks. And then here, this year, our new logo and our 30-year anniversary celebration. Normally, fund managers, they get all the glory, but this is here much, much more than just OrbMed. There have been so many important contributors, I think, to this fund. We have, I think, Winter Floods, our longtime broker, is here as well. But importantly, Frostro, Mark Pope, Alistair Smith, Grant Chalice, they have been instrumental in building this fund. They have been involved. They burned a lot of midnight oil here for getting this fund off the ground and keep it running on a day-to-day basis. And really importantly, I think we always had a really terrific board of directors. You see here the first green box. That's the original founding board of directors. This was an incredible group. But our leading chairmen, I think they were very, very important throughout the years. They had an important contributions, not just on the ups, but most importantly, I think where the chairmen are really good is actually on the downs. During the financial crisis, etc. And I think another interesting thing is the renewal of the board as well. You see here all of the green ones. They are board members which have retired over the years. And you see some important trend here in recent years. There has been a major, complete renewal of the board of directors. And unfortunately, we're going to see the final step in that in the retirement of Doug next summer. But this has been an important part as well in keeping the governance running in the fund. Next slide. This is really the fun slide. This is the reason why this was such a fun ride for 30 years. This is what makes me excited being a PM for a healthcare fund for over 30 years as well. These are the big innovations inside our sector. This is the lifeblood. This is the reason why the fund performed so well, because we have been investing in an incredible innovation-driven sector. This has not been a stagnant sector. This is some of the highest growth rate next to the tech sectors, what you could have experienced on Wall Street. And you see some of the really big milestones. So here, first one, Lipitor was launched in 1996. We had then the first monoclonal antibody launched, first biotechnology product coming, Rituxan, this was from Genentech. Then we had the first another biotechnology drug, Remicade, the first ADC, another biotechnology drug, Mylotarg. And then here, 2000, this was a banner year. It was a banner year, obviously, for the sector, but a banner year for science as well, when the human genome was sequenced. The next year was a really important year for cancer patients, because this is the year when the first targeted oncology drug was launched, Gleevec, transformative drug, a major change. A major change in the oncology sector. Then 2003, this is really exciting as well. This is why we all want to be in the medtech sector. Medtech has tremendous innovation as well. Here in 2003, we had drug-eluting stents approved and probably many of us probably are running around with a drug-eluting stent. So you know the positive effect of that firsthand. In 2004, the first big drug reaching $10 billion. 2005, the GLP-1 drugs, the ones which you hear about every day, Wegovy and Zepbound from Eli Lilly and Novo Nordisk, the big weight loss drugs. Actually, the drug class was launched in 2005, and now it's becoming full around. We cured hepatitis C in 2013. We again transformed the oncology space with an immunology agent called Opdivo. And then we had like the first drug reaching $20 billion, Humira, rheumatoid arthritis agent, which is a biotech drug as well. Oh, I forgot almost about it. COVID vaccines in 2020, another major biotech innovation. And now we had disease-modifying agents for Alzheimer's launched. And now we have seen actually the advent of the true mega blockbuster drug. This year's, Keytruda, an anti-cancer agent from Merck, will reach $25 billion. We will see this year the first $30 billion plus drugs, which will be Wegovy and which will be Zepbound, the weight loss agents from Eli Lilly and Novo Nordisk. And this has been really the driving force behind why actually we have seen this incredible performance of the fund over 30 years. And this is here all funds which have a 30-year investment record. So we are the number 2 performing fund out of all trusts in the UK since since April of 1995. So very, very proud of that investment record. But enough of the history. Let's talk about actually this year. And this year is a little bit more challenging. It's like healthcare has been a challenging space, not just for the past year, past 3 years, past 7 years, actually past 10 years. This shows you the 12 months performance, but probably the next slide gives you a little bit better explanation of our financial performance during fiscal year 2024. You see here the first 9 months. We have pretty much kept in pace with the MSCI Worldwide Healthcare, slightly outperformed. It was really hard-fought battle because the sector has been quite choppy, and it was actually selling off into the election and after the Trump election in November. But then the last few months of the year were really challenging with Trump declaring the tariff wars, major sell-off in the stock market, and this really accelerated, especially the risk-on part of the portfolio, the biotechnology sector. So create a really challenging 3 months, especially February, March last year. So if you look at the attribution here, you see here, I mentioned already biotechnology. Up till November, biotech was positive on the year. So all of the damage here in biotech happened here in the past 3 months of the fiscal year. This was mostly driven allocation-wise, not stock picking. Pharma, negative performance there, probably related to 2 stocks which we have subsequently, which we have sold, but not early enough. 2 positions, Merck and Novo Nordisk, they hurt the fund during the course of the year. They're all sold down to 0, but they created some negative attribution there. But the positive highlight here is the medtech sector. And medtech, I've mentioned that theme many, many times. It's a very, very important part of the portfolio. Over 1/3 of the fund is now in the medtech space. This is a space which is immune to any form of drug price controls. And you see extremely high growth rates and very, very high EPS growth rates. And we have been the core positions inside the funds. Some of the largest positions in the fund have been outstanding stock picks, and I think good sector allocations. So this is Boston Scientific, Intuitive Surgical, Stryker, and most recently Edwards. So here you see the big positive contributions, negative contributions by individual names. So Boston Scientific, MedTech, First two are medtech. Third one is actually a hospital company, Tenet. Fourth one is diagnostics, is a diagnostics company. Then the fifth one, a European biotechnology company. On the negative side, I think the leader there was Apellis, that was a biotechnology stock, where there was heavy expectations of an M&A takeout, which did not happen. And I mentioned already Merck and Novo Nordisk, and I think on the large cap biotechnology side, it was Biogen. Okay, so if we're coming to the fiscal year to date, this is a little bit better on a relative performance basis. See here the blue line, we are minus 5.5, but the MSI Healthcare minus 9.3, so we have quite a bit of alpha generation. I think this continued during the month of June. So we added another positive 100 basis points of alpha. But overall, healthcare is again actually at the bottom of the barrel inside the stock market. So healthcare is like out of the last 7 years, 6 of the last 7 years, healthcare has been at the very bottom actually of the stock market, despite all innovation. The 3-year numbers show the same trend. And here you see the blue line, the Worldwide Healthcare Trust, the MSI Worldwide Healthcare, which is flat for 3 years. We are slightly outperforming here on the 3-year basis, but it shows you the volatility inside our sector, and it's just simply not in sync with the market. Healthcare has not been in favor for quite a while. The longer term picture, I think you know that, has been a terrific fund for many, many years. And many times I said before, healthcare is not only important, this sector is not only performing for your personal health, but it's really, really important for your financial health as well. And you see here the benchmark in red. And then you see some of the largest pharmaceutical companies which have been around for 30 years. And you see big cap pharma companies, just investing in them gives you good positive returns, but you're not beating any benchmarks this way. The real recipe for success to beating the benchmark is you have to be exposed to innovative companies. You have to be exposed to smaller cap company. And that's a key part of the success. This is part of the reason why we had volatility recently. But the reason why we have been outperforming for the long term has always been investing in smaller, innovative, biopharmaceutical, diagnostic tools, medtech companies, not just simply the big old dinosaurs of our industry. So this leads us to the investment themes. So these are the more near-term recent investment themes. I will come to the longer-term ones later on. And this is quite interesting here. Here you look at presidential elections. How has our sector typically performed under a Republican government or under a Democrat government? You see here, the Bush administration was really positive because we signed something off Medicare Part D. It's a major shot in the arm. It was a great time to be a healthcare investor. I think when Barack Obama came into power, and especially since he had a sweeping Congress, it was really difficult here the first few years. Our healthcare was under pressure because he was implementing the Affordable Care Act, also known as Obamacare, and this was created a major overhang on the sector. But actually, the later year in the Obama administration turned out quite okay. But overall, Democrat administration, negative, I think, for the healthcare sector. Then Trump came into power, and actually the sector first sold off because, he made a lot of noise, not like a typical Republican president, but made a lot of noise about drug price controls. But in the end, I think he was overwhelmingly positive for the sector, and especially lowering the corporate tax rate. Then came the Biden years, very negative for our sector because Joe Biden administration had a major goal of lowering drug prices, and they implemented drug price control. So it was almost like the sector almost peaked from the Trump administration years. The day Biden got inaugurated, and it was a very, very difficult four-year period. And here we are starting, in 2025 with another Trump administration. So normally, logic would say, hey, this should be great 4 years actually for the healthcare sector. Well, the market begs to differ. There were a couple of macro trends, but it was, again, similar to actually first Trump administration. The first few months, making a lot of noise on populistic themes, which include lowering drug prices. And that has created quite a bit of volatility inside our sector again. But if history is a guide, this should be actually a good period for the healthcare sector. Now, the Trump administration, they have really cleaned up house. So they changed over every single part of the health administration. So they have a new FDA commissioner in place, which we think, by the way, is very, very positive. Dr. Martin Makary, I think he's been well perceived. But you see here, the one which was really controversial and became a major overhang on healthcare, and especially anything vaccine-related, is the HHS Secretary, RFK Jr. But this has created a little bit of uncertainty. And if you look at the changes, what they have done is they changed actually quite a bit at the FDA. So all of the major department heads have been replaced. And there was especially one guy, a new head for the CBER, Center for Biologics. There was Vinay Prasad, which almost created like instantly a 7% sell-off, one-day sell-off in biotechnology, because there was so much uncertainty surrounding some of these personnel appointments. But here, look at some of the headlines from our new FDA commissioner. And actually, in the end, it's quite positive. What does he want to do? Protect innovation through accelerating development. Wants to make things faster by reducing the red tape. And vaccines will continue to have a place in the sector. But here, the new FDA commissioner is actually talking about how can we speed up things? How can we make it easier for drugs getting approved to the market? How can we cut down the time it takes to run a phase 3 clinical trial? But nevertheless, Mr. Market thought all of those changes by the Trump administration, they are not good. They will create an overthing. We beg to differ, especially when it comes to the FDA. Now, another thing which we hear almost every day from the Trump administration is about pharmaceutical tariffs. But like so many things with the Trump administration, it's probably a lot of hyperbole, and I think this is a leverage instrument for them. Because what does he really want to do? With the threat of tariffs, he wants to reshore drug manufacturing. He wants to ensure that proper U.S. taxes are getting paid. And he wants to address national security. And what he's really after is actually after one of the neighbors just to the north of, northwest of the UK, which is Ireland. Because in Ireland, a lot of the big pharma companies, they are manufacturing drugs there. They have their IP there, and then they manufacture pharmaceutical products into the United States at a high cost. So in the US, they never pay taxes. They only pay taxes in Ireland, and they manufacture in Ireland. It's a few pharmaceutical companies that do it, and this is what Trump is after. He wants to reshore that Irish manufacturing back into the United States. And you have seen, I think, a lot of reactions by the pharmaceutical industry where they are giving actually a quid pro quo. So they have pledged over $280 billion in U.S. investments, both on the manufacturing and R&D side. So the industry is really reacting quite significantly, I think, to the pressures of the Trump administration. And it's probably politically wise, for the survival of the big pharma companies. Another favorite subject is most favored nations drug pricing. On the surface, this is like, oh, Donald Trump wants to lower drug prices in the US. He wants to be like another Democrat like Joe Biden. Let's lower drug prices to the maximum extent. But really, the real true driver behind it, he wants everyone to pay the same prices as the United States. And here, very, very similar to military spending. He's going after actually he's going after Europe. He's going after the UK because he does not want to have that the UK, Germany, or France are paying different prices than the US consumer. And this is what's really driving this behind. He's not really after the pharma companies when he talks about MFN, most favored nations. He's really talking about European countries. But here, what has happened actually inside our sector here, and this is, I think, an explanation why we had 10 years of underperformance inside the healthcare sector. We had 10 years of wall of worry, of constant rhetoric on drug pricing, where innovation was completely ignored. Nobody talked about innovation. Nobody talked about revenue growth rates and so forth. Everything was about drug pricing. And it started actually with Hillary Clinton in 2015 when she tweeted, price gouging in the specialty drug market is outrageous, and I will lay out the plan for it. This was the start of it. Bernie Sanders jumped in on it. Then here on number 3, that's Donald Trump, in 2018, who sounded just like Bernie Sanders and Hillary Clinton. And this continued every single year. Trump in 2019. Then the Democrats came into power. They did introduce drug pricing legislation. And then we have again Trump talking about executive orders on limiting drug pricing. And what's a shame? All these years, I feel like for the past 10 years, every single year I talk about drug pricing, politics, this president, that president, and I really spent very, very little time speaking about the innovation happening inside the sector. I've just, selected a few slides from every single year, highlighting all of the drug pricing. But this has been the wall of worry here inside our sector for such a long time. And this is the end result, and this is perplexing. This is something that surprises me. I've been in this sector for 35 years. I've seen a lot of biotechnology bear markets and a few bull markets, a few great bull markets. But look at this here, XBI, this is the Emerging Biotechnology Index. For 10 years, performance has been flat. I showed you earlier, all of the innovation that happened. And innovation really accelerated for the past 10 years. It didn't slow down. But you see zero reflection in it in the biotechnology sector. And even healthcare, look at the underperformance. MSCI Healthcare plus 91% for 10 years. Look how it pales against the S&P 500 or the NASDAQ. And this has been frustrating where for 10 years, fundamentals have been dispatched from stock price performance. And that has created a bit of a challenging environment. Now, a key thing what we always had was a major overweight to the biotechnology sector. And this is here really going back. This is our first annual report, what we wrote in 1997. I took a lot of time in March. Actually, I went through every single annual report since day one. And look at one thing what has been consistent every single year, 97, 2006, 2018, and today. We are always, approximately 1/3 of the fund is exposed to the biotechnology, to the biotechnology sector. This has been our key recipe for success for the really long-term chart that we've seen, where we're beating every single subsector very, very handily. But this has been as well the reason why is our 5-year number so poor? Well, because of that. That's what's caused it. But what are the reasons why we so stubbornly actually still stay with it? Why do we still
are so heavily invested for the biotechnology sector? Well, it's really simple. Look at this chart. This shows you as well. This is the past 10 years. And this year shows you from over the past 10 years, 40% of clinical trials in 2015 came from emerging biotechnology. Today it's 63%, a 50% increase just from this little tiny subsector, which is a fraction of the market cap of Eli Lilly, but 63 of new clinical trial starts coming now from small biotechnology company. Then the next chart. This shows you what percent of novel product approvals are coming from biotechnology. Here again, from 2015, you see 43% of new drug approvals from biotech, increasing to 85%. So now basically almost all drugs are developed by emerging biotechnology companies. And that, in a nutshell, is the reason why we keep on betting inside the Worldwide Healthcare Trust on biotechnology. This is why we will continue to be, close to 30% in the most innovative part of our sector. Another important part is M&A, because big pharma companies, their R&D pipelines are not productive. And how can they supplant their future growth rate? Well, they have to acquire. And where do they go? Biopharmaceutical companies. And typically you see one deal a week. It slowed down a little bit during when the Trump administration got started, but we are back up again to the usual run rate, and we've seen a really nice continuation. Most recently, we had a $10 billion deal by Sanofi acquiring Blueprint, and then Verona got. I think there is a buyout rumor today in the Financial Times. Maybe it's probably going to get confirmed later today that Verona is getting acquired by Merck, another $10 billion acquisition. So M&A is another very important reason why we have this heavy exposure into biotechnology. And you see probably inside our sheets, you see the M&A basket. M&A basket is to capitalize on this trend. Now, coming to portfolio and positioning. Here you see, so there have been quite a number of changes. In big cap pharmaceutical companies, there are really two core longs. It's Lilly and AstraZeneca, so it's very, very concentrated there. But overall, in the big cap pharma company, we're significantly underweighted. Other important holdings there are like a Daiichi in Japan, or a UCB in Belgium, which is inside the specialty generic sector. Then you see our exposure here in biotechnology here. It's 27%. And then you see the very, very heavy overweight in medtech devices. This is where some of our biggest holdings in the portfolio are. Boston Scientific, Intuitive Surgical, Stryker, Edwards are major positions inside the fund. But because it has increased so much, both in absolute in stock market terms, we have been on the sell side there. This is probably at the upper end of the range where we would ever be. I think another area which had been seen a really nice uptrend has been emerging markets. I think the biopharmaceutical sector in China has seen a major revival, and we actually added a major new holding, Jiangsu Hengrui, who is probably the most blue chip companies in the outlicensing trends of Chinese biopharmaceutical drugs to Western companies. So this is an important new position, which is in the top 10 holdings. I think here on leverage, I think we do feel there is a bounce coming back. We will get a reversion to the mean inside our sector. So we are here at 115% gearing level. This sector is incredible cheap. And I mentioned it before, underperformance for 10 years, 6 out of the last 7 years, almost worst performing sector in the stock market. Now here looking ahead, and this is where I come back actually to our presentation that we had in March, and this was the exercise what we did. What will be the big 10 mega trends we will talk about 10 years from now? Now we spent a ton of time on this in March, so I'm just going to summarize it on it. Now, one thing I always get asked, what's artificial intelligence? What's the impact there? Are there great artificial intelligence plays inside the healthcare sector? Now, AI is transformative inside our sector, but they are not per se just purebred AI companies like a NVIDIA inside healthcare. But AI will be transformative for the sector, both on the drug development side, but more importantly on diagnostics, screening, surgery, and actually how you're going to get treated by your general practitioners. This is where the impact is really happening. Now, 5 major mega trends what we see in the next 30 years happening is in the therapeutic space. And what we are going to talk a lot about is cures. Is cures, not just making diseases a chronic disease, but possibly talking about a cure. My favorite one there is obviously the oncology space, where you have it's a very diverse indication where you have 200 types of cancers. But what you will see is not just simply transforming a cancer that you live with it for 20 years and you die of something else, but you're actually going to get to functional cures. This will be a combination of better diagnosis, better treatment mechanism, targeted therapies, cancer immunotherapy, cell therapy, and we are getting to curative states. I think another really big area where we're going to see incredible innovation is in the neurology space. This is the last big boundary for biopharmaceutical innovation. If we can get to disease-modifying agents first, and then actually cures for Alzheimer's disease, Parkinson's disease, Huntington's disease, this is going to be a major driver of longevity. This will be the next push where people average life expectancies goes well into the late 80s is if we address this neurology, oncology, and then the CNS space. But inside the neurology space, if I would be standing here in 30 years, which I will not be, but somebody else involved in it, I think this is probably one of the key areas. We're going to talk about cures in Alzheimer's disease, and how terrific would that be? I think another area which I would highlight is how the cardiovascular disease space is changing. And this has been very, very important. After vaccines, antibacterial agents, the big next push in the life expectancy upwards was number one, intervention cardiology, like implanting stents or heart valves, but importantly, like blood pressure lowering medications, your statins for lowering cholesterol. But now we have this new class of GLP-1 inhibitors, and they are transformative, not just for weight loss, even so that's what everyone talks about, but where they're really transformative is really in secondary diseases, in the major chronic disease indications. If you are on a GLP-1 inhibitor, you will prevent 90% of type 2 diabetes. Just think about that. You're on a GLP-1 inhibitor, you're going to get very, very slim, fit in all of your suits, but at the same time, you lower your chance of type 2 diabetes by 90%. Very similar, very high ratios on stroke, heart attack, liver disease, kidney disease. It's like almost runs across the gambit. These are transformative drugs, and that's the reason why this whole drug class, the GLP-1 inhibitors, is going to be the $100 billion mega drug category, and this will be as well transformative over the next, actually this is here now, this is over the next 5 years. But this page, this is why I think average life expectancies will significantly jump up, and I think we will have a major inflection point there. The other key area, almost as exciting, actually in some areas even more exciting and even easier to understand, is actually in the non-therapeutics space. One of our favorite companies is Intuitive Surgical, which is the leading robotics surgical robot. And this technology is really transformative. It already has started, especially in the United States, that certain surgeries, if you do not get operated on by a Da Vinci robot, by Intuitive Surgery, it's malpractice. And when you talk to key opinion leaders in the surgery field, they're using the robots even for open heart surgery. They're using it on the brain in every single area. And I can foresee a time, in 15 years, where I think a surgeon is replaced by a surgical robot. And probably ultimately all of us are going to experience it. I've never been operated by a Da Vinci robot, but I'm actually kind of looking forward to it. It would be exciting. It will be minimally invasive. A big major surgery is turning into a very, very minimally invasive surgery, which is taking a recovery time instead of like being in a hospital 3-4 days. You're going to be there for 1 day with minimal incision marks. So super exciting, that area. Diagnostics is going to revolutionize. I think by 10 years from now, I think one thing, what we are going to see, that you're going to go every year, get a full body scan, MRI body scan, and then you're going to get a blood diagnostic test. And you're going to run it through a GP, which is AI-driven, not a human, but AI. And they will be much more efficient and much better at predicting, what disease you have. There was just recently a new study published in the New England Medicine on where they compared actually AI diagnosis with a traditional GP, and the AI outperformed the traditional GP by I think 4 or 5x. So the GP was only 20% accurate in predicting the disease, while AI was 80% predictive. And this is where I think a major transformation is going to happen. So this is artificial intelligence. This is where probably going to replace your general practitioner. And AI, what it will replace as well, is waiting time. Just think about that. How long do you typically wait? Seeing your physicians. You don't have to wait for AI around. So this is going to be major transformation. Actually, the last slide is kind of really interesting. That's a really interesting one. And actually, nobody has talked about it. It's not many people have talked about that. Could we actually see healthcare cost price deflation? Because everybody expects healthcare costs just keeps on increasing. United States, as a percent of GDP, we probably have peaked. It peaked in early 20s, 22%. It has now come back down to 18, 19%. In the UK, it's on an uptrend because it was really low, 8, 9%. It's going now to 11%. But if you ask around the room, where everyone would think, what's the driver of healthcare cost inflation? Got to be those expensive pharmaceutical drugs. Nope. It's 10%. 10% of healthcare expenditure is going to be for pharmaceutical drugs. And that is ever lowering because you have genericization of major drugs. So when drugs goes off patents, $30 billion drugs becomes suddenly $100 million drugs when the drugs are introduced by generics companies from India. So that slice will never go up. What's the other 90%? That is actually the provider space. This is when you go in for surgery. This is hospital costs. This is surgery costs. This is GP costs. And I talked about in the previous slide, where are we going to see, I think, the innovation? Well, if a robot is going to operate on you, if your GP is an AI robot as well, shouldn't actually the overall healthcare expenditure go down? I could think so. I don't think we're going to have a continuation of healthcare cost inflation. And that's in a nutshell, actually, the big 30-year trends that we are seeing. But now coming back, what does it mean to for our fund? Look, I think where I'm very, very comfortable is that our recipe for success, what we have shown for the first 30 years, that's very much in place. Nothing has changed there. I think our allocation strategy in being in the most innovative companies, while it increases sometimes the volatility of the trust, is the right recipe for success in the long term. This is how we will beat, I think, our benchmarks going forward. And this is how we will beat, I think, hopefully, broader benchmarks, just like we've done for the past 30 years. I think near term, the big wall of worry of drug price controls, politics, macro trends, I think it will be fading. It is discounted in the share prices. And one thing is for sure, M&A trend will continue exist.